YouTube family, what's good? If you new here, I'm Dub Washington, and I do two things. First and foremost, I ensure that everybody eats. And secondly, I make the banks compete to lend you money. And in today's session, I want to be breaking down the current lending climate, profile structuring for you to go out and get access to your first 7 figures in funding. Yes, I said 7 figures, as I have amassed over 2.3 million in funding currently and counting. Another important topic that I'm going to be breaking down is some credit approval tips that nobody is talking about in the current lending climate, in the credit space. No matter where you go, you're not going to find this information that I'm going to be breaking down to you in the understandable manner in which I break it down. So listen, man, say your grace and let's jump into it. All right. First and foremost, I need you to understand that the number one reason why businesses fail is due to lack of capital and a future funding round. I have a thing called a structure card. So once I get access to capital, whether it's 100,000, 200,000, no matter the amount that I get funded, I'm going to at least take 1 to 2 credit cards from that funding sequence and take that to build future funding rounds. Meaning that I'm going to liquidate the money off of the card, and then I'm going to start making banking deposits into institutions that I intend to go for funding once this particular 0% APR phase runs out with this funding round. I always break it down in a manner like this. The owner is playing a different game than the GM. The GM is playing a different game than the head coach. The head coach is playing a different game than the quarterback, even though they're all on the same team, but they're looking at the overall situation from a different perspective and a different scope. So I want you to understand credit at a very high level to where you making the banks compete to lend you money. So credit standards have been tightening ever since 2022, and it's a result of coronavirus, COVID-19, right? During this time, March 2020, we had a situation that shook up the whole world. It was economic uncertainty. Nobody knew what was going to happen, and everybody was pretty much operating within a mindset of scarcity. So what ended up happening was the ratio reserve was decreased from 10% down to 0%. If you don't know what I'm talking about, the banks and credit unions used to have to keep 10% of reserves of deposits from the consumer pretty much held up at the bank. But in 2020, I want to say the date was March 25th, somewhere around that time frame, 2020. What ended up happening was the Federal Reserve lowered the reserve ratio rate to 0%. So now imagine how greedy that the banks are and how much money they were pushing out. So that's why you see that, 2020 to 2022, banks were lending out a lot of money, but then as a result of them lending out money, being greedy, they were lending out money to unqualified consumers, unqualified business owners, which resulted in a high default rate. So if you fast forward to today, we are currently at the highest credit card debt that we have ever seen. And along with that, we are seeing more default rates than we have ever seen in history. So as a result of that, the banks have been consistently tightening, trying to mitigate risk. The last thing that the bank want to do is lose money. So one thing you got to understand is how the banks operate. They operate within fractional reserve lending. So they're taking money from us as the consumer, and then they're issuing money to another consumer or another business, etc. And then they're charging a split on money that's not even theirs. So let's jump into it today, man. First and foremost, I'm here to break down the bank data secrets that the banks do not want you to know to ensure that you get high limits. And a lot of that will involve you auditing the bank. But before we jump into that, I just want to revert back to the quality of the profile. Now, whenever we're talking about the quality of the profile, how risky does you and your business look on paper? For the personal side, quality high limit comparables are going to be very, very key. Always remember, the banks are judging you based on what you put on your consumer report. So we don't want to add too many credit builders. We don't want to add too many builder accounts to our profile, as that makes us look risky in the eyes of the banker. Once again, we take a different approach over here, family. We take a much different approach than most. So now as we get to the business side, because remember, personal guarantor, you're going to pretty much have to PG all of the loans and all of the loan products that you get from an institution until you're getting around 4 million in revenue, right? And there's some other institutions out there that will lend to you solely based on the business's revenue, but these are typically high APR credit products which you can't really leverage. The name of the game in which I teach in my mentorship is how to go out and get access to 0% APR funding to scale your business to go to the next level. So as we get into the quality of the profile, the personal side is going to be very key with the quality, high limit comparables. And on the business side, let's get spicy. Your industry NAICS. How does a particular institution view your NAICS code? You got to understand that part before you go and try to obtain funding, because little known facts is consulting is deemed as high risk for certain institutions. And the reason why it's deemed as high risk for certain institutions is let's look at the bank reports. Let's look at the quality of accounts that they have lended out and look at the default rate associated with those accounts that they lend out for the specific NAICS code. We all got access to the same information in 2020, 2021. We started a consulting business and then we go to the bank and we get funding based off of stated income. But as the bank lended out this money, you have to understand there are a lot of default rates associated with the specific NAICS code. We really have to understand the particular institution and determine if it fits within their risk tolerance. So whenever you're trying to go and get funding from an institution, the transaction itself is very important. If you're going to an institution that does not specialize in business lines of credit and you're trying to obtain a $100,000 business line of credit, the likelihood of you getting that from an institution is going to be very low, even if they offer the product. So you have to understand if the transaction itself fits into their risk tolerance for your specific NAICS code. Outside of that, what is the financial health of your business? And the financial health of your business is solely going to be dictated upon your recent payment trends and how often you have been making the payments. If I say recent payment trends, if you have maxed out credit cards on the personal side or maxed out credit cards on the business side and you've been making that minimum payment, even if it's within a 0% APR phase, the banks are judging you that. So I talk about it a lot in my mentorship as well, as like what banks are going to report what information to what bureaus. Because whenever you go for business credit products, they're not only pulling your personal credit, they're also pulling your business credit. So as you go along and you understand this, you have to make sure that all of your ducks are in a row. Now, having documents will get you higher amounts. Paperwork is the key to longevity in the funding industry. If you have paperwork to provide to the bank to show that you are a profitable business, they're going to want to lend you money. You just have to make sure that you are within your risk tolerance to get the max exposure. Now, to determine if you should be asking for the max exposure, we really have to sit down and audit the bank. So I'm going to be breaking down some notable FAQs that you must understand about the institution to ensure that you're able to get the maximum exposure. First and foremost is, what bureau do you use? Do they pull from TransUnion, Experian, or Equifax? Not only what bureau do you use, you have to understand what bureau for product. There's going to be different requirements for a line of credit versus a credit card. There's going to be different requirements from a credit card to a loan, right? So you have to make sure that you understand what bureau is going to be used for the product that you are going for. PNC, for example, if you go for a business credit card, they're going to pull your Experian FICO 8. But if you go for a line of credit, they're going to be pulling your Equifax FICO 3 score. So knowing what bureau they're going to pull for each individual product will greatly improve the chances of you getting higher limits. Now, from here, we want to know, what FICO score are you going to use? If you're not familiar with the 16 different versions of your FICO score, on this channel, I dropped a FICO masterclass breaking down how you can build up each individual FICO score to ensure that you get high limits, whether you're on a personal side or business side. Definitely catch that. Once you understand what FICO score is going to be used for the individual product, you now want to know what are the required documents for a specific amount. This is where we get good at. If you don't have documents, you want to request a lower amount than a maximum exposure. Any amount is better than nothing, family. So what does this look like? If the max exposure is $100,000 for a business line of credit, and it requires statements, and you do not have those statements, you should go 75,000 to keep it at stated income. And this could vary per institution. It could be 50,000, it could be 40,000, but you are doing your audit on the bank to ask the correct questions. This is what we're doing in 2025, families. We are auditing the bank and making them compete to lend us money. Now, once again, requirements will vary depending on the product that you apply for. But now that we're talking about lines of credit, you now have to ask the next question, which is, what percentage of revenue do you lend off of? So once again, if you know the max exposure, you know what to put on the application. And once again, you're not falsifying any information. You're using projected revenue, or you're using projected income to use for this particular application. And that's what I'm here to do, is show you how to audit these banks and make the banks compete to lend you money. Now, for me, business credit cards are going to be the best overall product, as they are no documentation most of the time, and they carry a 0% APR phase, which is my absolute favorite, because you can leverage OPM while not paying any interest on the money, and then paying them their money back while you are profitable. What other place in the world has a credit system like the United States, man? We're living in a great space. The 0% APR will allow you a little bit more flexibility. So as you're going through, you have to understand what particular loan product is best for you. For some people, they love lines of credit. Other people love business credit cards. Some people love loans. Some people need equipment financing. No matter what you need in your journey, you must understand how to audit the bank and make them compete to lend you money, family. And that's what I'm here to do. But those are a few notable FAQs that I like for you to understand before you start building with each and every institution. If you want a more in-depth list of how to audit the banks, what question to ask, I put together a free PDF for you, family. All you need to do is text the word LIST, LIST, to 864-721-8750. And then I'm going to send you a free document to understand what questions to ask whenever you're walking into the bank. I'm giving you the answers to the test. So once again, in 2025, we making the banks compete to lend us money, family. Now from here, lines of credit and business credit cards both have benefits. You just have to understand which one will benefit you the most to get you where you're trying to go in your financial journey. But once again, for me, business credit cards are going to be the winning product, as they offer 0% APR. But it doesn't stop there. Whether you're on a personal side or business side, you have to understand there are different types of credit cards. So you could get points credit cards, you have balance transfers, you have cash back, you have 0% APR, you have charge cards, you have secured cards, right? So all of these are different products within the credit card sector, because each one will specialize in different ones. You have travel that's associated with the points. So it's many different things that you can go and get a credit card for, solely outside of the limit. Because once you get to 200, 300,000 on the personal side, you should only be grabbing cards that's going to pretty much give you a great welcome bonus, a sign up offer, etc., to where you can leverage it to get some free travel, etc. Right? Now, as we get to lines of credit, this is a great one right here. Ensure that it is a true line of credit. Unlike credit cards, whenever you have a line of credit, you can transfer that limit over to your checking account and you're automatically liquid. With a credit card, you're going to have to liquidate the money, and then, whether you use manufactured spending, whether you use a liquidation process, etc., you're going to most often be paying fees associated with it. But with the line of credit, you're able to just transfer the money from this line directly to a checking account, and now you're liquid. But once again, whenever you get into the lines of credit, you have to understand a multitude of things. And one of the things that I previously discussed was, what percentage of revenue does this particular bank or credit union lend off of? These are questions that you must ask. The number one thing that we should never say when we go into the bank is two words: No, doc. I don't ever want to hear you say that whenever you walk into the bank. The bankers don't want to hear you say that because they judge you off of what you say. But once again, if you get my free PDF by texting LIST to 864-721-8750, you're going to know what questions to ask once you walk into these institutions. Now, what institution is right for you? Is it the national banks? Is it the regional banks? Is it the credit unions, or is it the local community banks, right? So all of these are going to have their pros and cons associated with it. No matter where you at in your journey, there's a bank and or credit union out there that wants to lend you money. You just have to be the ideal client. Now, many credit unions will have geo restrictions. We're going to bypass these geo restrictions by joining the American Consumer Council and using the promo code Andrews. This is going to get us free access to the American Consumer Council, which opens up hundreds of credit unions, typically that will have a geo restriction, but because you're a part of this American Consumer Council, you're now able to bypass it. Listen, family, I got gems for you. Outside of that, whenever you are going to credit unions, you got to understand that there are niche lenders. I want everybody to do one thing for me. Once you complete this video, go and Google top lenders for whatever industry that you could think of. We're talking about golf course owners, veterinary practices, Korean American businesses, hospitality, healthcare, dental. Google the best lending institutions for a specific niche. These are called niche lending institutions, and they specialize in specific industries. Not a lot of people talk about this information now, family. From here, once you understand what their industry that they choose to lend out to the most, you want to understand, is the bank or credit union healthy as far as the deposit ratio? This is very key here. You can go to the SLUs, you can go to FDIC, right? The SLUs is the Senior Loan Officer Opinion on Bank Lending Practices, which basically tells you how many banks are tightening up, how many banks are loosening, how many banks are pretty much staying somewhat the same as far as lending practices. But these are valuable resources that you can use to determine what institutions you want to go to, and overall, if you should be going to national, regional, community, or even credit unions. Everybody's situation is going to be different. Don't look at someone else's funding sequence and try to duplicate it, as your situation is unique to you, and you should know how to leverage your unique situation. As we get into the deposit ratio, what are the deposits looking like over the past 3, 6, 9, and 12 months? If banks are decreasing in deposits, they have less money to lend out. If they are increasing in deposits, they have more money to lend out. So you understanding the deposit ratio is going to be very key in you determining what banks you want to build with for future funding rounds. Remember, family, we have a structure card. And whenever we get our first round of funding, 100,000, 150,000, we're going to take 1 to 2 cards out of this sequence to say, listen, this credit is not to invest. It is to go and build future funding rounds to ensure that I have another 0% APR phase once this one closes out. What you don't want to do is be caught up holding debt with nowhere to transfer it to at 0%. Now you're just giving the banks money. So once you understand what specific type of lending do they typically lend their highest limits to, now you want to go to the risk tolerance for your NAICS code. If the highest default rate is coming from your NAICS code, that's telling their bank everything they need to know about your family. Some institutions have a foreign entity filing exposure, meaning that you can come in and file a foreign entity to operate within this state, within this community, within this zip code, and then they're able to lend money to you. But certain banks, certain credit unions, if the original documents are not within their radius, they may not want to lend money to you. So whenever you are going out structuring future funding rounds, you want to know, what's your foreign entity tolerance? Some banks don't like them. So you have to ask the questions on, how do you feel about it? Do you lend out money to foreign entity filings, even though the original documents were not within your geographical footprint? So now that you have went on your mini audit, you understand what NAICS code do they lend out the highest limits to? What's the max exposure? What's the max exposure for each individual product? What documents are required? You now need to know how to structure your 7-figure portfolio. You must have a structured card to ensure that you can continuously build out 0% APR funding. One thing that I always ask my mentees whenever we open up our calls, right, is what does your 0% APR bag look like? What I mean by this is, what banks can you go to right now and get access to 0% funding? Are you structuring a $150,000 sequence? Are you structuring a $250,000 sequence? Some of the mentees has went and amassed over $2 million in credit themselves from the teachings that I break down in my mentorship about how to audit the bank. So now you went through, you done your mini audit, right? Now we got to know how to build the relationships. And this is my 3, 5, 90 sequence, family. And once again, do not over leverage yourself. But if you go to 3 to 5 banks every 90 days, understand the bank's application rules, but put yourself in position by liquidating money from your initial first round of funding to structure that funding round, you'll never run out of 0% APR funding. And that's the name of the game. We want to go out and get business credit at 0% APR for extended time frames. We're talking about 12, 18, upwards of 24 months. And then we're going to take 3 to 6 months with this 0% APR to set up another 18, 24-month sequence. Do not let that information that I just told you go over your head, family. We are taking money that's not ours, 0% interest, upwards of 18 to 24 months. We're taking 3 to 6 months with our structure cards of that one sequence, and then we're going to build other banking relationships. So if you go on a $100,000, $150,000 funding sequence, the rule of thumb that I always recommend is to take anywhere from 20 to 25% of what you are getting from the banks to set up rounds. And you don't have to do it the entire duration of the 0% APR, but let's just say that you do it for 3 to 6 months. Banks are built out in quarterly cycles. And if you were to take 40,000 of the 150,000 that you just got, what you can now do is structure 4 different banks to give you access to more funding down the line. You only use 6 months of the 18-month 0% APR phase, family. So you took less than a fourth of the APR phase to build out another 18, 24-month phase. This is how we supposed to operate, family. And while everybody is out here struggling to get access to capital, we're making the banks compete to lend us money, family. So the structure card is very important as you are going through your journey. I don't want that to go over anybody's head. So I just want to come on here today and just break down a quick little sequence for you to determine what banks are right to build with, what's their risk tolerance, what's the foreign entity filing exposure. A lot of the questions that you must ask to ensure if this is a good business partner. As we know, banks are nothing more than a business partner. So that's it for me today, family. I appreciate you. And in my words, everybody eats. Let's go.